Hi everyone, welcome to our DAT IQ Weekly Market Update. This is the episode 318 for December 3. I'm Dean Croak, Market Analyst here at DAT Freight and Analytics, along with co-host Chad Kennedy. Today, a special guest all the way from the west of the country, Zac Rogers from Colorado State University. Great to have you with us, Zac.
Yeah, thanks for having me. I'm excited to be here.
Yeah, it's been a while. A bit early for you out that way. We appreciate you getting on early and talking us through today's release of the Logistics Managers Index.
For DAT, I would have been here at 5 a.m. It's no problem.
You're the man. Chad, all good down your way? I noticed hurricane season ended.
Yeah, we finally got it behind us, so that's a relief. We've got a cold front. It's been, I think it was 39 when I woke up this morning, so that's refreshing for us. Yeah.
I got a little bit more on that later. Zac, for those new to the show that don't know you, can you tell us a little bit about what you do out that way and your contribution to the Logistics Managers Index?
Yeah, absolutely. So I'm a professor of supply chain at Colorado State University in Fort Collins, Colorado. And for the last a little more than 8 years, I have been the lead author of the Logistics Managers Index, or the LMI, which is a diffusion index that we put out every month where we sort of track movements in the overall logistics industry. And it's been a really interesting year in 2024, partly because of how not interesting it's been. It's been the calmest, most normal year that started with a 20 that we've had. And so, I've been working on that and then plenty of other things as well. Excited to be here.
All right, good. We'll bring you back in a little bit later. I'll get into the market update and some of the key trends we're watching, including the LMI. Some of the key things this week, of course, it was a short work week last week, just 3 days, maybe 2.5 from a shipping perspective. Capacity was tight though, load post way down, loads moved way down, obviously. Rate movement last week was much the same as last year and what we'd expect seasonally. There were some markets that did show some higher rate movement. Outbound California up 8 cents a mile on 12% lower volume. Top 5 markets across the country up 4 cents a mile. Florida spot rates are up 8 cents a mile. Georgia up 10 cents. Up at about 8 cents a mile across the entire southeast region. So some interesting rate movement regionally, but capacity did tighten. Exits continued from the industry. There were fewer entrants joining the market in November, about 17% fewer in November compared to October as measured by new carrier authorities. Revocations were down about 9%. The net change, though, saw about 1,000 fewer carriers in November. That's about double the number from the prior month. We've been losing about 7,000 carrier authorities each month so far this year. This month's number wasn't too far off the long-term average. This is also something Zac's going to talk about a little bit later in his LMI report as he talks about capacity for larger and smaller firms. The LMI, as Zac mentioned, it's been increasing for about 12 consecutive months. He's got some good news to report there. And of course, hurricane season ended over the weekend as one of the deadliest. I went back and compared the NOAA May forecast to what eventuated. The 2024 hurricane season, it saw 18 named storms. NOAA predicted 17 to 25. 11 of which were major hurricanes. They predicted 8 to 13, so they're right in the midpoint. And 5 of which reached major hurricane status at Cat 3 or higher. They predicted a range of 4 to 7. And of course, 3 impacted Chad's region, setting a record for the most in Florida for a single season. This week's market update that'll be out this evening, we're looking at check week results from back in May. Our operating costs for owner-operators and small fleets is also out for November. Carriers are back in the black for the first time this year, but only just. Christmas tree shipping season in Oregon, and of course some of the latest information on residential home construction from the Census Bureau. So let's dive into the market update and talk about our load posts in dry van. Obviously way down last week on a 3-day week. Capacity tightened as carriers took time off. Net result in the load to truck ratio was a decrease to 3.76. Similar trend in the refrigerated market. Volumes are down about 50%. That's fairly normal for a week-over-week change. Once you get into a short week around Thanksgiving, most of the shipping activity and reefer occurred in the 2 to 3 weeks prior. Load to truck ratio stands at 4.44. This time last year it was 3.17. And in flatbed, the load to truck ratio down by about 28% to 8.87. Again, I wouldn't read too much into that. It's very similar week over week movement compared to this time last year. Having a look at our year-over-year look at spot rates, even though the loads moved down 18% last week, capacity tightened. There was a shortage of available capacity. Rates were up 4 cents a mile last week in dry van. That's the rolling 7-day average. At $1.71 per mile, rates are about 5 cents a mile higher than last year and about 10 cents a mile lower than 2022, as you can see on the chart. On our top 50 lanes, based on the volume of loads moved, carriers were paid an average of $2.05, that's excluding fuel. That was up 7 cents a mile last week, and it's about 34 cents a mile higher than the 7-day average. Dry van line haul rates remain 6 cents a mile higher than the 3-month trailing average. And in the refrigerated market, after increasing by 9 cents a mile since the start of November in the lead up to Thanksgiving, reefer rates began their typical seasonal cooling off period last week, down a penny per mile to a national average of 2.05. Reefer rates are about 10 cents a mile higher than last year and about 7 cents a mile lower than 2022. And lastly, in flatbed, line haul rates increased by another penny per mile last week to a national average of $1.98. They're about 8 cents a mile higher than last year and 2022, and identical to the 3-month trailing average. Let's have a look at our short-term forecasts. These are our forecasts out 35 days. These exclude fuel. These are true line haul, long haul forecasts. To help you with the colors on the chart, the blue line is the rolling 7-day weighted average of historical rates over 550 miles. And then you've got some other colors there with that show us what Ratecast is doing. The green is where Ratecast thinks rates will go out 35 days. The yellow line is the higher bound of the forecast, and the red is the lower. So let's start with dry van. Lots of similarity this week, in fact, between all three of the models. They all reflect stronger demands through Christmas, particularly over the next 3 weeks. Even a little bit of tightening of capacity between Christmas and New Year as capacity exits the market for the break. In dry van, Ratecast is expecting rates up 12 cents a mile out to the 4th of January, ending the year at about $1.84. Low case scenario up 5, high case scenario up 20. Last year spot rates went up 9 cents a mile over the same forecast period. The forecast back then was for an increase of 8 cents a mile. So Ratecast is going to be pretty well on the money this year, looking for a 12 cent per mile increase in the next 4 weeks. Similar story with the refrigerated sector. It's expecting rates to dip about 5 cents a mile in the next week to 10 days before taking off in the last 2 weeks of the year, rising 19 cents per mile by January 4, averaging about 226. This time last year, spot rates went up 25 cents a mile over the same forecast period, but 14 cents a mile of that was between Christmas and New Year. And in flatbed, Ratecast is forecasting an 11 cent per mile increase out to January 4 to 210 per mile, low case 4 cents a mile up and high case 14 cents a mile higher. Last year, spot rates went up 8 cents over the same forecast period. The Ratecast forecast this time last year was for 9 cents. So again, Ratecast is pretty close to the money, as it reflects a lot of long-term seasonal trends as we'd expect. All right, so that's the short-term spot market forecast. Over to Chad for a look at some of the more interesting trends on the contract market.
Yep, thanks, Dean. So I'll cover the contract rates from our shipper data. So what I'm showing here on the top is our shipper rates, all rates, it includes spot and contract, the total mix. Going back to 2016, and we're using our 2016 model as a comparison here. So you can see the change of rates over time on the top graph there, seeing that boom and bust cycle. And you can see there at the very far right there that there's a slight trend up, very slow and steady. So we are reporting now for the month of November with the data that we have in so far, still contractual deflation of 0.1%. And on the spot side, it's inflation of 5%. For a net inflation of 0.9% in November. That was 0.2 year-over-year increase inflation in October. This is primarily or completely driven by spot with that 5% inflation in spot. And you can also see there in the bottom right corner that mix of spot freight increased to 17% in November versus 16% of spot mix in October. That is the highest that we've seen since September of 22. So that spot mix being a good indicator of the market shifting, routing guide leakage, shippers having to rely more and more on spot. So we're seeing some positive trends for brokers and carriers, more concerning trends for shippers. But I think overall, probably pretty good trend for the economy. Let's go on down to reefer. So reefer, again, same thing on the top graph, the historical trend, and then year over year on the bottom graph. For all rates, we're seeing 0.5% deflation still in November, but you can see that trending up towards zero. And as that tips over zero, that's moving into a more positive scenario for brokers and carriers. That spot mix also increased by a full percentage point from 14% to 15% increase in spot utilization for refrigerated rates. The mix on spot and contract is about the same here in reefer. So spot inflation, 4% year over year, contract still deflation of 1.3%. And then finally for flatbed here, we're seeing continued rate decreases on that top line there. Rates still trending down. And inflation year over year is actually had a tick down for the month of November. So flatbed sequential rates declining, flat to declining. And whereas we see 25% mix for flatbed, much more mix, that's for spot, much more spot mix for flatbed than we see for dry van and reefer. That's a wrap on the contract rates, Dean.
Yeah, thanks. Very interesting trends there. All right, so let's bring Zac back in. Zac, easy question to start off. You had some really good insightful commentary in your LMI report out this morning. What do you think the economy is going to look like in 2025 and some of the challenges we might be facing?
Yeah, no. So, the overall index this month came in at 58.4, which is a very steady rate of growth and really consistent with what we've seen the last couple months. I think before this we had a 58.9 and a 58.6. And so and what's funny is the 2 months before that we had two readings at 56, and 2 months before that we had two readings at 55. And so it's almost been like a stepwise function with the sort of expansion of the logistics industry. And it's been very healthy and normal, actually. Like I sort of mentioned at the top, we have seasonality again, which is nice. I think we all kind of missed that. That was fun. Yeah. And so we have seasonality, and what that's done is it's made a very sort of predictable market. But we've had this growth that's been unlike the growth that we've seen over the last 8 years. And basically you can sort of track the overall logistics industry and I think the overall economy by looking at when we have something called a freight inversion. And so a freight inversion is when our number we have for transportation capacity flips with our number for transportation prices. So when capacity suddenly goes higher than price, or price goes higher than capacity, either side. And if you look back at all the inversions we had up till now, here's what they were. Right after the big tax cut, trade war, COVID, and there was kind of two right in the beginning of COVID where it went down and then spiked back up again with the stimulus, stayed high with the stimulus, dropped like a rock with the invasion of Ukraine and inflation. And all of these inversions had been really sharp, the curves crossing really sharply. Well, in 2024, they've kind of slowly gone back and forth. And now we've seen about 6 to 7 months in a row where transportation prices have grown faster. And really what we're seeing is the most sort of organic inversion that we've had in the 8.5 years we've been doing this. And it's driven by things like capacity. I mean, like you mentioned at the top, Dean, capacity is sort of slowly contracted. Didn't drop out, partly because all these carriers had cash on hand from the last few years. Didn't drop out like crazy. And so we've really seen sort of the, I think, well-run carriers have stayed in the market. And we've also seen a lot of capacity take a step back last year and say, hey, we'll wait for prices to come up again. And that's really reflected in our movements in capacity, where we'll go right down to right about 50, and then we'll pop up to 54, down to 50, pop up to 52. And I should say for everyone who's not familiar, 50 is sort of the line we have. Anything below 50 is contraction, just like the PMI. Anything above 50 is expansion. And so we haven't actually had transportation capacity go into contraction for about 2.5 years. we'll get close and then we come back up. And what that is we have excess capacity that's been waiting in the wings and is coming back on. And so when that comes back on, price then moderates again. And so we haven't seen the big runaway prices that were highly inflationary, by the way, in 2020 and 2021. Instead, what we've seen is sort of slow and steady growth. Now, how will that continue on? Because that's really the question you asked. We ask our respondents, hey, 12 months out, where do you see everything going? And remember, I said that we're at a 58.4 this month. Well, 12 months from now, our respondents who have been very accurate, other than times where there was a global pandemic or European land war. Other than that, they're pretty good. They said 63.6, which is a little above average growth for the overall index. The overall index, I believe, is 61.7 over the 8.5 years. But 63.6, I mean, that's within, a quarter of a standard deviation of normal growth. And what it shows basically is that we will be adding inventory. So inventory is growing in around the 60s. A lot of that driven upstream by wholesalers and manufacturers. Retailers are still certainly seem like things will be kept fairly lean going forward. And then price is increasing, but price is increasing in a way where, again, I don't believe it will be highly inflationary. And the reason for that is because going forward, both of our measures of capacity for transportation and for warehousing are numbers in the 50s, which is like we're adding on capacity as we go, basically. Like I said, normally when we see an inversion, capacity drops through the floor, and suddenly it's in the, we had a time, I think in 2021 when maybe transportation capacity was like 27, just like a crazy great. That was the supply chain problems era when it's at 27, and now it's 53.5 for the next year. So again, what it shows is that we're going to have, according to our respondents, growth in the logistics industry, especially in freight, but growth in a way that can be supported by existing capacity. Now, for carriers, the good news is that our price predictions are 80.9, which is a pretty good rate of growth. So, and a lot of that is, as I think, going to be driven by the expectation of, well, as interest rates continue to go down, construction might pick up. We saw the housing market looks pretty good last month, and I think that's encouraging for a lot of people. We know construction obviously soaks up a lot of volume, and there's other things in there I think will soak up volume as well, including the sort of healthy consumer we have. And so basically what it shows, I think, is that we've been in basically a slow but steady recovery over the last year, really. And our respondents believe that the market is primed to continue to grow into 2025, but that growth might pick up and go at a slightly faster rate, and certainly at a faster rate when we're looking at things like freight prices.
Hey, Zach, on the transport pricing piece, that forecast result that you got back, I think it had a score of 80 on transport pricing. And I think that was
80.9. Yes, sir.
Yeah, broken down, upstream 82, downstream 77.
Yes.
What do you think accounts for that difference? Is it that I assume it's retailers on the downstream. Is that more private fleet, dedicated fleet concentration, and maybe they're not expecting more price increases than manufacturers that are spending more on over-the-road common carrier freight? What do you think accounts for that difference?
I think that's part of it. I think the other thing is that we've really seen upstream firms, up until the last 6 months, upstream had really been keeping their powder dry. Downstream by its nature, I think, just has a lot of turnover because of consumers really, we never had, despite what people thought might have happened or was going to happen, we never had a recession in the 2022 sort of post invasion time when inflation was crazy. I think a lot of people thought we might, and the reason we didn't is because of downstream. So consumers stayed strong. Americans will spend our way through to the other side. We got credit cards. We can do it. But upstream, everyone was, or at least a lot of folks we were talking to, and a lot of the firms in our data seemed like they were keeping their powder dry. We have these big, the Inflation Reduction Act, the CHIPS Act, all these things that should drive a lot of construction. Well, that comes through and interest rates are growing, up like crazy because of inflation. And I think that a lot of upstream firms had been eyeing 2025. If interest rates come down a couple more quarter points, I would expect at least a quarter point at the next meeting in December. I think they've been keeping their powder dry, and there's anticipation that there will be some CapEx, there will be more movement, and that sort of potential energy that was stored up over the last couple of years will sort of come out as kinetic energy, and because that there will be a lot of freight demand. The other thing I think we see on that, Chad, is that it's not just manufacturers up there. We have a lot of distributors in our upstream group, and distributors and wholesalers, their role has really changed in some ways since the pandemic. You guys remember during the pandemic, we had that goofy debate about, is it JIT or is it JIC? Just in time, just in case. And we went a little too JIC, obviously, in 2022 and had the biggest inventory bullwhip of all time. So we've gotten away from, retailers are going to stock up like crazy, but really what's happened is we've still kept some of the lessons from the pandemic, where we're not going to just wait until the last second to order something from over the ocean. And so we've seen a real growth in sort of middle mile warehousing. If you look at where warehousing is going in, where is it? Phoenix, Dallas, Las Vegas, Austin, a lot of these sort of inland, almost waypoints. And especially if you go to Phoenix or Vegas, a lot of these are distribution centers.
Yeah.
California's full, basically. And so what's happening is we're still bringing in a lot of inventory early. We saw huge spikes upstream for inventory all throughout the summer. Downstream was like contracting May, June, July, August. Upstream was building inventory up like crazy, pulling inventory ahead. But what was happening is, so we're still pulling it ahead early, like we did during COVID. But then, like we did pre-COVID, the retailers aren't taking it. And so we have this big sort of massive inventory at this middle mile. And that's a lot what's reflected, I believe, upstream as well, is that downstream is basically they're trying to have it both ways. They're trying to be as JIT as possible, not take on too much inventory ourselves. Target had a $2 billion write-down in 2022 that they don't want to keep doing that, but not have the sort of supply constriction problems that we had in 2021, where everything was on the other side of the ocean. And so basically we're bringing things over early. It's sitting here for longer, which is driving up some of that upstream busyness, and then moving to the retailers in the first place. It's really, in many ways, sort of a synthesis of pre-pandemic and pandemic strategies coming together. And that's a lot what we're seeing, I think, with that upstream downstream split.
Zac, you touched on it. For those that are listening for the first time, can you just sort of articulate how you define upstream, downstream, what those folks look like in the market?
Yeah, absolutely. So downstream is essentially retailers. Any of our respondents that are sort of directly consumer facing, like say Walmart. I'm not saying Walmart's in here, but if they are. But if Walmart's in here, that's who we would say is downstream. Upstream would be like, a 3PL or a manufacturer, a distributor. Basically, if you remember back to your beer game you played in your intro supply chain class, downstream, that's the retailer. Everybody else, the wholesalers, manufacturers, raw materials, that's our upstream group.
Got it. Fascinating. Thank you for that. Reading the report, I was really interested about how your respondents view transportation capacity different based on the size of the firm. Can you speak to that a little bit more and why you think that might have been the case?
Yes. So that I agree. Dean, I thought that was that the sort of split we have between large and small firms was one of the most interesting things from the November report. And so we split out our respondents. It's not terribly scientific. Basically, we say, okay, more than 1,000 firms, more than 1,000 employees, and we have many of our respondents are 10,000, 20,000 employees. Anybody over 1,000, you're on one side. Anybody under 1,000, you're on the other side. That's sort of the dividing line we use. And we saw a lot more activity for small firms in November than we did for larger firms. And that is also a flip of what we had for most of the year. Small firms, kind of like upstream, what we were saying, kept their powder dry all through the year. And that's because, small firms, they can't take big risks. I think they were really waiting to see, hey, is this really going to be a solid holiday season? And as we saw from Black Friday and Cyber Monday this week, I think, yes, things seem like they're doing okay. In October, spending was up. But the small firms didn't want to make that bet early. They don't have a lot of cash sitting around. And I think they're also probably in some ways, you see the cost change because of spot versus contract stuff with them. But so in November we had small firms bring in inventories at a high rate. They were 63.4. Larger firms, so firms over 1,000, 50. 50 again means no movement. Now it doesn't mean they weren't bringing inventory in. Amazon obviously had trucks coming in this month, but they also had a lot going out. And so basically the larger firms are really able to sort of maintain that JIT that we were just talking about. Because a large firm, it is easier for you to say, hey, wholesaler, hold on to this until the second I need it. And so some of that middle mile difference applies to large versus small as well. And so, sort of the larger firms were sort of sitting, not moving things as quickly. And small firms, really what it reminds me of the small firms is sort of pre-pandemic ideas of we're going to bring everything in at the very last second, and it's all building towards Black Friday. Whereas maybe with the bigger firms, you have the Black Fall concept where things are spread out more. Small firms are still sort of traditional in some way. And so because of that, transportation capacity got tight for small firms. They're bringing in all this extra inventory. So smaller firms, their inventory levels came in at our transportation capacity came in at 47.8, whereas larger firms were 56.7. So it's like a 9-point difference. And as a result of that, we also saw they had a 10-point higher transportation price, 69.1, to the larger firms, 58.8. And so really what I think it shows a couple things. One is the strategy of we're bringing things in later. And so we're really busy with these smaller firms versus bigger firms. And it's not just, you got to remember a lot of times I'm talking about it like it's just retailers, but it's not. A lot of times a smaller retailer is also going to be linked to a smaller carrier or a smaller 3PL. And so I think we kind of see it moving through the ecosystem. And then the other piece would be because they don't have the sort of buying power to lock up a lot of capacity and get those economies of scale, it's always going to be harder for them to find a truck, and it's usually going to be more expensive. They may be relying more on spot than on contract relative to larger firms. And so it's a really interesting difference we saw, but I think it's a great difference. I actually think it's really encouraging. And the reason is because, we've sort of had this divergent recovery over the last couple of years. We've had, macro numbers. Hey, GDP is really good, but people are like, well, inflation's still high, spending is still crazy. And we've sort of had this recovery where at a macro level, things have looked pretty good for a year and a half, but at a micro level, there were still some problems. And thinking about it, and partly in the context of the election we had last month, I was looking at it and realizing, larger firms have really been much busier than smaller firms all through the year. And that's not normally how things are. Normally we have some equilibrium between them. And small firms are really kind of the lifeblood of the economy in many ways. And so now in November, for the first time in really 2 years, to see smaller firms overtaking large firms and becoming busier shows, I think, that the recovery that's been happening in the logistics industry and in the freight market, we think the freight recession ended really this summer, but it didn't end everywhere. But now it seems like it's ended both for the big guys and the little guys, and we weren't going to have a full recovery until that happened. So what I think we're seeing, it's such a great question you brought up, Dean, is a much more holistic recovery on sort of all types of firms in the supply chain really, really happened in November in a way we hadn't seen all year.
That makes a lot of sense. Zac, one other thing I picked up in the November report was the intermodal growth. It looks like up 9.5%. Any insights on that? Do you see that as a short-term seasonal impact, or is that a knock-on effect from increased imports, or is this a longer-term like truckload rate pressure moving freight into intermodal?
Right. I think it's a couple things. I think one, yes, the imports piece are huge. If you look just at, say, the Port of Los Angeles, we're up 30%, 20% year over year, every week, basically since like May. So, and some weeks have been really, really huge, like right after the hurricanes on the East Coast. And so that's part of it, is things coming in. And I think as we build up this middle mile structure, a lot of those middle mile warehouses are being fed intermodally. Whereas maybe you would have came out of Riverside on a truck before. Now maybe you're coming intermodal into Phoenix, into Dallas, wherever. I also think some of it is price pressure. Like we said, we keep seeing trucking capacity come off the sidelines as prices go up. One of the other things that happens as prices go up is, look around, see if there's other options. And I think intermodal has benefited from the sort of freight recovery on the trucking side. It's really, I believe, a rising tide, raises all ships situation. And intermodal has benefited from it. I would also anticipate, just, kind of anecdotally talking to folks, that inventory is being pulled forward right now. Normally we don't see a lot of inventories being pulled forward in December, but we are seeing that right now. It looks like in terms of the forecast of the Port of Los Angeles, at least. And anecdotally, as I talk to companies, they're saying, well, just we don't know what's going to happen with tariffs. It seems like it changes all the time what the plan might be. And so we're just going to pull some things ahead now. And so I certainly think intermodal will continue to benefit from that, at least for the next couple months, as firms try to make sure they're on a good footing, for whatever policy changes we might have in 2025.
Yeah.
Maybe last question just to wrap up. Talk about tariffs generally lead to inflationary aspects. Do you think, you mentioned the Fed might cut interest rates another few basis points, maybe a quarter. What do you think that does to interest rates next year, and any long-term impacts on, say, manufacturing?
So I think that the Fed under Powell has shown that they are cautious. They're not chasing anything. They're letting the market come to them. And so I wouldn't be surprised. I mean, I still think there will be a cut in December. Maybe not. I mean, it does seem, the tariffs right now are so hard to predict because they are certainly inflationary. I would anticipate a cut in December, though, because of just the fundamentals of the market. But I don't know after that. It's difficult to say. What I can tell you is that one of the freight inversions, which we were talking about at the top of the show that we had, came in 2019 as a direct result of the trade war. The trade war between the U.S. and China that really began in the summer of 18. The summer of 18 is when you see the market start to turn. And then by the time we get to early 2019, those lines cross. And, imports soak up a lot of capacity, and so do exports. You forget sometimes. I mean, some people forget. I know you guys wouldn't. But, when tariffs happen, they usually come back in the other direction. And based on things I'm reading and sort of looking at the tea leaves, China certainly, I think, has more optionality now with us in terms of how to retaliate for. I don't think in 2018, I don't think China really thought tariffs were going to happen. I thought they thought, oh, this is a negotiation tactic. This is interesting. And then suddenly 25% on aluminum and steel and chemicals and semiconductors. Well, many of which are still there, by the way. And I think that because of our vulnerability with things like, say, rare earths, and it's not just, we tend to look at the tariffs as just that first tier supplier, but there's so many tiers going back that, okay, even if something's being manufactured in Taiwan or South Korea, lithium is coming from China or something like that. And so there's a lot of tightening that I think could happen and really be difficult. If I just, kind of back of the napkin, we import about $500 billion of stuff from China. That's what we brought in last year, $500 billion. Well, if we have a 60% tariff, that's another $300 billion. And if there's about 300 million people in the United States, so that's about $1,000 a person, just with no math, basically, just on the back of a napkin. That is inflationary. Yeah. And so if inflation does pick back up, I mean, it would be such a bad time for inflation to pick back up because we just got this thing really nailed down. Then I do think you'll see the Fed being more cautious. And I wouldn't be surprised then if we see a pullback, especially from those upstream firms in 2025, if interest rates creep back up and if, capacity coming into the ports is really impacted negatively. Now, I'm hoping it's a negotiation tactic. I would also say it's unlikely that we'll be hit as hard as a freight market as we were in 2018 and 19. just as a function of the diversification that's happened. We really are China plus one supply chains, where before we were just kind of China supply chain. And so, it doesn't seem like, of course, if the tariffs with Mexico really happened, that'd be a problem. But it seems like that was something that we talked about for a weekend. They had one phone call and now they think, oh, maybe it's fine. But, the real problem with the tariffs, guys, I think is the uncertainty. Supply chains need certainty. If you don't know, hey, the price might go up 25% or it might not, that's a difficult contract to make. And supply chains, because of all the planning that's taken and just the scale you need, you can't just supply chains can't be jazz, they need to be somewhat steady. So if there's a lot of tariffs, I think that would be tough. I do wonder on the timing of tariffs, because tariffs are sort of something you can do without Congress because they're sort of executive orders. So maybe other things get pushed up to the top, like a tax cut, which, by the way, the tax cut was great for the freight market in 2018. Things really picked up. So maybe they do that first when you still have maybe some cohesion in Congress. And then later on, you could bring in the tariffs if you want. I would, if the Trump administration hasn't asked me to come on yet, but if they did, I would say, hey, if you want to pull back on regulation a little bit, tax cut, I understand how that could be beneficial. Right. Wait on the tariffs. Let's wait and see on inflation, hopefully coming down.
Right. It's fascinating. I'm sure he's got you on speed dial, Zach. He'll be.
We're old pals. Yeah.
Yeah. All right. That brings us up to the conclusion of the show. Zach, before we go, how can people get in contact with you?
Yeah, well, anyone can send me a note at Zac, ZAC.Rogers, ROGERS, at Colo, COLO, state.edu. Cal State had CSU already, so we're Colo State. I'm happy to add anyone to the distribution list. This report comes out the first Tuesday of every month, around usually 7 a.m. Eastern, the first Tuesday of every month. And we have the last year of reports up on our website, which our website is the-lmi.com. The last year reports are up there for free. And we spend a lot of time writing this every month, and so I'm always happy when more people more people read it and it can be helpful.
All right, we'll make sure everyone knows about that. Thanks for being on with us, Zach. A couple of shout outs on Chris Kaplas's Freight Bind podcast. Kevin Zwire is talking about bid season. Next week's show, Professor Jason Miller is with us, and Ken Adamo should be making a guest appearance talking about the freight market, and of course Michigan versus Ohio over the weekend. There could be some trash talking going on there, I'm sure. Make sure you sign up for alerts to our show and subscribe to our channel on YouTube. With that, another show is in the books. Be safe, be nice to everyone. We'll see you here next week at 10 a.m. Eastern, 7 a.m. Pacific.
Well,